Look, anyone thinking about emerging market bonds right now probably feels like they're staring down a loaded gun and no one's telling you where it's aimed. These markets can look like a gold mine on paper, big yields, diversification, faster growth than developed markets. But if you don't know the tight corners hiding in the shadows, you're setting yourself up for a brutal wake-up call. You're frustrated because every time you chase yield, volatility bites, and uncertainty turns into losses faster than you blink. You hate feeling like you're guessing in the dark, like the usual analysis just glosses over the real threats. That's the real hell here. The surface looks calm, but underneath it's a mess built on shaky assumptions. And if you're not sharp, you pay the price. Here's the raw deal. Emerging market bonds are not just about credit risk or political risk in a general sense. It's deeper. It's about the fragility inside these economies that nobody's shouting loud enough about. Something that can blow your entire portfolio apart if you just buy the headlines. Inflation is wildly unpredictable. Central banks in some countries don't have the tools we're used to in the West, which means when inflation spikes, interest rates might jump off the cliff without warning. That destroys bond prices overnight. If you're clinging to the idea that rates won't rise or that it's just a temporary phase, you're ignoring the reality that these countries can't just print money or cut rates whenever they want without consequences. Then there's the question of liquidity. Don't fool yourself. Emerging market bonds often trade in thin markets. When the global mood shifts, everybody wants out. But guess what? You won't find buyers easily. So your diversification might turn into a dead asset just sitting there. No way to sell without a massive haircut. If you think liquidity crises are just a Wall Street myth, think again. They'll freeze you out when risk aversion hits the fan, and it's brutal. Now let's talk about currency risk, because this is the silent killer. Local currencies in emerging markets can tank in a heartbeat if political instability spikes or if the global dollar strength surges. Many investors forget how crucial this is. Hedging? Sure. Easy to say, but hard to do efficiently when the instruments are expensive or unavailable. If you ignore currency risk, that yield you're chasing just evaporates after conversion. It's like drinking poison because it tastes sweet in your glass. Here's what you must do. Yes, actually do, not just think about it. Start by demanding full transparency and never accept vague promises. Scrutinize fiscal policies like your life depends on it, because it does. Countries burdened with heavy debt, especially foreign currency debt, are ticking time bombs. Watch their payment schedules, government deficits, and the political will to pay, not pay lip service, but pay cash on the table. Identify who's really committed to reforms and who's just delaying the inevitable. Next, use active management. Passive investing here is a trap. You need teams digging into macro changes daily, political shifts, social unrest, and evolving global trade trends. These aren't markets where a set-and-forget approach works. You want people who can pull you out fast or on the buy side before value disappears, and don't just rely on spreads and ratings. Look at sovereign support and external buffers. How much foreign reserves do they have? What about their relationships with big institutions like the IMF? This is your lifeline during crises and the difference between a temporary wobble and a complete collapse. Last, diversify not just by country, but by sector and maturity. Shorter maturities help because they reduce exposure to long-term shocks you can't predict. Avoid crowded trades. When everyone rushes in, the risk explodes. And get comfortable with complexity, because the simple, high-yield emerging bond label won't cut it anymore. You need to layer strategies, like pairing emerging market debt with global macro exposure, or carry trades that offset currency swings. Ignore these facts and you're gambling with pain, not investing. These bonds aren't just about chasing returns, they're about navigating a minefield with your eyes open, every step measured and guarded. This is for those who want control, who want to actually build real value without giving their money away to blind luck. So stop pretending emerging market bonds are a plug-and-play option. Get ruthless, get detailed, and get ready to move faster than most think possible. Because in this game, hesitation kills portfolios. Subscribe to our YouTube channel and check the featured link to learn more.